Welcome to This Explainer. Today we're demystifying the stock market and honestly trying to normalize some of that investing anxiety we all feel. I've been diving deep into some absolutely incredible insights from market expert Ben Carlson. He's the director of institutional asset management and wrote a fantastic book called Risk and Reward. Let me tell you, his work completely changed my perspective. It gave me a super clear roadmap for building long-term wealth and, more importantly, how to actually survive the market's wildest, most stomach-churning swings without losing my mind. So let's kick things off with a totally wild scenario. What if you had literally the worst luck imaginable? Seriously, picture this. You painstakingly save up your hard-earned cash, but you only ever pull the trigger and invest right at the absolute peak of the market. We're talking mere moments before a historic, bone-crushing financial collapse. Would your financial future just be entirely ruined? Is it game over? Well, we're going to answer exactly that today. Here is our roadmap. First, we'll look at the reality of market risk, then your brain on volatility, the crazy story of the worst market timer, investing through the decades, and finally, how to build the perfect portfolio. Let's jump right in. All right, Section 1, the reality of market risk, or what we like to call the silent threat. We really have to start by asking, why even take the risk at all, right? Because leaving your money safely tucked away in a savings account under your mattress feels, well, safe. But it's actually not. Inflation is this completely silent threat. Think about it. If inflation runs at just 3%, the actual value, the purchasing power of your cash, is literally cut in half in 23 years. Cut in half. You are practically guaranteed to lose your standard of living if you don't expose your money to at least some level of market risk just to beat that inflation. But here's the truly crazy part. Historical data proves that the market consistently recovers, always. Even if you invested right before the Great Depression, and we're talking about enduring a terrifying 86% market crash, if you just closed your eyes, held onto those investments for 30 years, and reinvested your dividends, you still would have seen an annualized return of about 8%. No way, right? But it's true. The market always bounces back and finds new highs. Moving along to Section 2, your brain on volatility and the psychology of investing. So if we know the market always recovers, why is it so agonizing to endure those inevitable drops? Well, it all comes down to our incredibly human behavioral quirks, starting with a big one, loss aversion. Ben Carlson actually calls this the absolute most important concept in finance. It's this psychological glitch where a 10% drop in your net worth emotionally damages you, like twice as much as a 10% gain brings you joy. It's just human instinct. It makes us want to slam the panic button the second we see red on our screens. And then, of course, we also suffer from recency bias. This is the one that makes us feel completely invincible when the market is going up. But on the flip side, when the market is crashing, recency bias tricks our brains into being absolutely convinced that the downturn is just never going to end. It heavily distorts reality, and it actively pushes us to abandon our perfectly good long-term strategies just because of a short-term panic. Oh, and we can't forget the sunk cost fallacy. This is where our emotions just completely take the wheel and we stubbornly hold on to a genuinely bad investment simply because we already spent a ton of effort or money buying it. We just sit around, crossing our fingers, waiting to quote-unquote break even, instead of objectively looking at what the best place for our money is today. Which brings us to Section 3, the worst market timer. Everyone, meet Bob. To really show you how managing your behavior absolutely crushes perfect execution, let's go back to that wild scenario from the beginning with the story of Bob. Bob is officially the world's worst market timer. He saved up all his cash and only bought into the stock market on 4 specific days in his entire life. And those days, right before the catastrophic 50% crashes of the 1970s, the 1987 crash, the dot-com bubble, and the Great Financial Crisis. I mean, his timing was impeccably terrible. But crucially, and this is the whole point, Bob did one thing right. He never sold his shares out of fear. He just held on for dear life. And the result? Despite having the absolute worst entry points in human history, because Bob extended his time horizon and just stayed in the market, drumroll please, he still retired with a staggering $1.1 million. I know, it sounds fake, but the math checks out. The lesson here is incredibly powerful. As long as you don't let yourself get scared out of the market, time and compounding are your ultimate allies. Ben Carlson sums this up perfectly. He says the average stock market return is never average in a given year.
He points out that while the historical return of the market is roughly 10%, it almost never actually hits exactly 10% in any single year. A typical up year is more like a 21% gain, and an average down year is a 13% loss. Ben relates this to tennis legend Roger Federer. Think about this. Federer won 80% of his matches, right? But he only won 54% of his total points. The stock market is exactly the same. On a daily basis, it's barely better than a coin flip, but you have to embrace that crazy daily volatility to secure the long-term rewards.
Okay, Section 4, investing through the decades. We're talking time versus financial capital. So how does this actually translate into a real-world strategy as we age? Well, Warren Buffett famously said, "It's pretty easy to get well-to-do slowly, but it's not easy to get rich quick." Building wealth requires immense patience. And that's exactly why younger generations really shouldn't feel pressured into making reckless, highly speculative bets just because they feel like they're falling behind. You can't just jump off the couch and run a marathon, you know? You have to build up to it slowly. When you contrast these life stages, it makes total sense. A 20-something has the incredible luxury of time, right? They have the human capital to easily recover from a highly volatile 100% stock portfolio. They can afford to just sit back and wait out a bear market. Conversely, someone in their 50s or 60s, or retiree, they must protect the financial capital they've already built. They require a balanced barbell strategy. That means combining the safety and liquidity of cash or bonds on one side with growth stocks on the other. This ensures they never ever have to sell off their investments at a loss during a temporary market crash to pay for groceries. Honestly, it turns out that regardless of your age bracket, achieving financial independence really boils down to a few surprisingly simple steps. We're talking save 10 to 20% of your income, automate those savings so you don't even think about it, increase that amount just a little bit over time, diversify what you own, and finally, resist the urge to endlessly tinker with the plan. If you do these basic things, the rest is just gravy. And that brings us to our final part today, Section 5, the perfect portfolio, surviving the ride. When you really factor in our human emotional limits, we kind of have to completely redefine what a perfect portfolio actually looks like. There's this great saying, "You're never going to make a killing, but you're not going to get killed." And that quote perfectly captures the essence of true diversification. You willingly give up the chance of hitting a massive concentrated home run just to guarantee that you won't strike out and lose your entire life savings. It's a trade-off for sure, but it's designed to protect you from yourself. You absolutely must build an emotional hedge into your plan because, let me tell you, historically, you are completely guaranteed to experience some bone-crushing volatility along your wealth-building journey. Just look at this data. Since 1950, the S&P 500 has seen 39 separate drawdowns of negative 10%. It's had 11 drops of negative 20% and 3 utterly terrifying drops of negative 40%. If you can't control your emotions during these completely unavoidable events, it honestly doesn't matter what your perfect portfolio looks like on a fancy spreadsheet. Basically, what this all means is that holding a slightly less aggressive, maybe technically suboptimal portfolio, one that actually lets you sleep soundly at night, is vastly superior to a mathematically perfect plan that you end up abandoning in a blind panic. Giving up on your investment strategy at the absolute bottom of a market drop is completely indistinguishable from just having a failed plan from the start. So we'll leave you with this final, somewhat provocative thought for today's explainer. Since there's clearly no perfectly smooth path to wealth, are you going to let your emotions hijack your future? Or are you ready to choose your heart? Investing is going to constantly test your patience and your nerves, for sure. But if you respect your own behavioral biases, if you build a plan you can actually stick with, and you just let time do all the heavy lifting, those long-term rewards, they are entirely yours for the taking.